dividends on workers' comp policies are not created equal. I don't care what your agent's telling you, it's simply not the case. There are a lot of things that need to be considered when you get put on a workers' comp program that has a dividend. The first one is whether or not you're even going to get it, and the answer is it's not guaranteed. It's not guaranteed at all in the state of Florida. Dividends have to be declared by the board of directors, and then they're issued. The second thing you need to know is when you're going to be able to get your dividend. When will it be valued? And a lot of that depends on the wording in the quote. Once the policy's in place, it's not going to be able to be changed. So if you're looking at two workers' compensation quotes and all things appear to be equal, guess what? One may pay you a dividend 6 to 9 months after the policy ends. Another one might not pay it for 18 months. It's important for you to know so that you can project your cash flow and know what your return on investment is going to be in your insurance and risk management program. The next thing you want to know is what type of loss development factors are going to be applied. How are they going to ultimately value claims that are still open? If you have open claims, you're more than likely not going to get the entire dividend, but even if you don't, the value that you get is going to be predicated on how much they value what's left to be paid before a claim is closed out. Know what they think a loss is going to develop to, because that becomes a huge issue. Know whether or not there's a recapture provision. What happens if you have a great year, you get an awesome dividend, and then all of a sudden, through no fault of your own, a claim is reopened, and a carrier comes back looking for some of that dividend money back? Not a good conversation to have, but one that's entirely possible if there's a recapture provision in your dividend program. Again, not something you want to be surprised about when a claim happens or when you don't get paid on a dividend check. You need to know when everything is quoted. And last but not least, you need to make sure that the company has a good history of paying them out. What is the stair-step provision look like? Meaning, how quickly do I fall off in terms of a percentage of premium I get back when I go from no losses to 5% losses, to 10% losses, to 15% losses, because every single company that offers a dividend has a matrix just like that. Again, you might be at 20% with no losses, but one company may be at 18% on a 5% loss ratio, and the next one drops all the way to 10%. Take the time to figure that out. And here's a bonus. I thought I was done, but I'm not. Don't go for a flat dividend if you have great performance. Right now, carriers are trying to slide 20% flat dividends in front of great performing accounts. And you know why? Because they make more money if they do that. If you have had a loss ratio of 5% or less for the last 5 to 10 years, why would you cap yourself at 20% back on a dividend if you could ultimately get 40% if you took a sliding scale dividend and had a great top side to it? If you don't understand how to look at all this stuff, if your agent's not talking to you about it, feel free to reach out. We're happy to give you a dividend projection based on the exact plan you have in place right now at absolutely no cost. Click the button down at the bottom of this post, request a time for us to talk, and I can assure you, we won't put the hard clothes on you. We're not going to try and sell you anything. Our work product sells itself.